Right, and the next type of relief, which is also possible, is this idea of gift relief. And ultimately, what we have here is a scenario where it's another type of relief or holdover relief, so to speak, where we are literally deferring again that gain. Now, the gift of an individual the gift of an asset may give rise to CGT liability for the donor, even though the donor has not received any funds with which to pay the tax. So the whole idea is you're receiving this gift or you're receiving this business, and you don't quite have the asset, the money to pay for it. Remember, with entrepreneurs relief, we had a scenario where you had an individual who was selling off and going away. You know, it's done. He's sold off, and he's paying tax on. He gets his reliefs and he pays the tax on the capital gains. What we have here is someone sort of passing on a business, if you like, of certain qualifying assets to a second person. And the question here is that there is still a gain. The question here is that who is responsible for this gain, who will pay this gain, and then it's the person who's receiving. Well, the problem here, of course, becomes the person who is passing on the goods might not have the money to pay for that tax at that time, so they gift it instead, and that defers, if you like, that gain in the future. So it's very much a way of helping or managing this problem of being able to pay the taxes so the businesses continue. But sometimes you'll see what I mean. It is possible that you might want to pay some of it so we can sort of fix how we arrive at that figure. But let's just go through the theory very quickly. So the key point is gift relief allows the gain of certain assets to be held over or deferred until the asset is eventually sold by the donee. So the person who eventually pays the tax will be the person receiving the gift of the assets. Right, so and both people have to make a joint claim, the person giving and the person receiving. So of course at the time, no gain or reduced gain, depending on how we want to fix this. We'll come back to this arising. And there is a chargeable gain again arising on the donee later, which will be taxed on disposal. So provided a claim is made, gift relief is available. And the qualifying assets, again, you can see here, this is very much to do with this idea of running businesses, unquoted trading shares, assets used in the trade of the donor, and quoted shares of the donor's personal company. Personal company must have at least a 5% of the voting rights. So the key point here is we're trying to ensure that the business continues. And literally, it is as we've done so far. It is very much about rolling those gains into the new asset. Let's look at this example here, just to sort of see what's going on here. So it says here, Elias is a greengrocer. He gifted his shop to his son on the 14th of March. At that date, the shop was worth 978. So here are the proceeds. Sells the shop to his, or gifts the shop, forgive me, to his son for 978. I think it said his son. Yes, he had bought the shop 10 years ago, so cost, he bought it for 225. Then he spent 96,000 on it, taking that shop all the way to 0005, and 6 is 11. 6 is 11, 1, 3, and 9 is 12, 1, 321. So this is the cost of this shop. So what we now have here is a gain of 657,000. So now, under entrepreneurs relief, what would have happened was that Elias would have taken this extra 657, taken off his annual exemption allowance, and taxed the rest at 10%. Using up his basic rate band. But now he probably doesn't have that money anyway, if you like. So what he does is he gifts it to his son, or maybe he wants the business to stay within the family. I mean, he could have sold it to his son, to be fair, for 978. He could have, and his son would have given him the money if his son had. If you see what I mean, he could have done that, but his son might not have had the money. So key point here is that's the gain. But what we can do, we say, okay, listen, look, because you're gifting this to your son and we want this business to continue, you can elect for gift relief, which means that we then, this isn't rollover relief. So what we now have is that we have the new cost of the shop, and we deduct the gain of 657 from it, which brings it back down to 321,000. So technically, the shop retains its original cost of 321,000. Sorry about that. If you can hear that noise in the background, teachers just put on a music system. Hopefully, it stopped. So that's 321,000. So that's how gift relief is used, basically, to keep the business continuing, so to speak. That's that. So I mentioned earlier on that it is possible that we could manage this so that, and this is where we talk about here, planning points to consider with gift relief. I think it's a bit of practice and you get used to how this really works. You might be able to, if you think about it, imagine his son did have some money. I think that's kind of the issue here. So that, because you see, as soon as he does this, Elias wastes any opportunity to use his entrepreneur's relief. He wastes any opportunity to use his annual exemption allowance. So you can imagine all of that goes. The son will now have to use his ER and his AEA, and where we could have started using some of it. So what we can do is we can manage this so that we can deal with that. So we can't allow for partial gift relief claims, but we can sell it we can still ask for some money, and that will help us deal with this. So this idea of getting some money from the person you're selling to is referred to as sales at an undervalue. So let's sort of see how this works. So what we now ask, you see, so it says the chargeable gain and the gift relief are done as follows. The market value of the date of the sale at undervalue is used as the proceeds in calculating the gain. Fair enough, we know what the gain is. We always want to know what the gain is. That's not the issue here. And then what we do is that if the actual proceeds received are less than the original cost of the gift, all of the gain gets rolled. But if the actual proceeds are greater than the original cost, any excess is chargeable CGT. Gift relief available is available on the remainder of the gain. Let's see an example here. I think that's always the best way to see this. So what we now have here is that Glenn sells a freehold shop to his son for 180,000. So the shop had cost 150, and it's valued at 480,000. So the question here is, what is the actual gain? This is the gain, 480,000 minus 150,000. So this is the actual gain. The question of the debate about how much we can roll forward into the cost of the asset is the difference here, which is 330. This is the gain. So this is the first place we always want to. What is that gain, first of all? Now, in a way, the question here is that Paul, again, it says here, Glenn sells it to Paul for 180, and it originally cost him 150. So again, what we have here is we have a scenario where kind of almost think of it like rollover relief. Just think about it like this. Glenn is going to get 180,000 for something that cost him 150,000. So Glenn will straight away get 30,000. So out of this 330,000 gain that can be rolled over, he is realizing right now 30,000, right? Which means that technically we can roll over the difference, right? That means that 300,000 can be rolled over. So in effect, what his son is doing is increasing his base cost so that the next time he sells this thing, he doesn't have to worry anymore about this 30,000. It's no longer in that gain bracket that he has to deal with. So in effect, he has a shop worth 480,000. He can roll over 300,000 in there, and so the base cost is in effect 180,000 as opposed to 150,000 if he hadn't paid his father if he had paid his father. You can see it really depends as to how much gain. It's all dependent on what gain, or how much more than the cost that Glenn gives, that Paul gives his dad. So the greater it is than the 150, then that is the extent to which Glenn gets some gain. So your task always is, well, how much of that gain, what has Glenn received? Glenn has received 30,000, so therefore we can knock that off and roll over the rest, if you like, into the cost. And that's the way to kind of sort of see it. I mean, sometimes when you read this, it does seem quite convoluted, but here we are. So again, it's about working out whether or not he's got something. And if he's got something above the original cost, then that is chargeable, if you like, straight away. So I think it's always working out that, and then we'll see questions that allow us to play with this a bit more and make it practical. That's that. And I think I can actually go ahead and do, I think that might be yes, why not? I'll just finish off on this last point here. Again, like I say, this is really to do with people. This is to do for business. This is to do with business. So what we have to always be careful of is when you have assets that are not used wholly for trade purposes, we need to think about, we have to exclude those assets that have not been used for trade purposes. So, so here we have this example here. The restriction does not apply to shares unless they are shares in the personal trading company. And that's really the issue here. So what we have here is that someone's been gifted, we'll see, gifted shares in a donor's personal trading company. So we want to kind of apply gift relief to that, but not all the assets in that area. I mean, we have chargeable assets, of course, but not all of them are chargeable business assets. So we want it to strictly relate to chargeable business assets. So what we then do is we just kind of have to find the chargeable business assets, chargeable assets, and then as a proportion, only allow that gain, that gift relief to apply to those. So you can see that the chargeable assets, again, chargeable investment buildings and things like that are not chargeable business assets. No, they must be to do with real things. If you like, we'll see machinery and to do with the actual trade. And chargeable assets are just all the assets in general. Although we do have some exempt assets. So let's see an example again to sort of see how this applies. So what we have here is this scenario where James makes a gift of 2,500 shares to his daughter. It's a trading company, it's limited, it's not a PLC, when they were worth £30 each. So the first thing we want to find out is what is the gain. So the gain, if you like, that she's made, that James is wanting to gift relief, is the 2,500 shares at £30 less the 2,500 shares at £5. And here we have 75,000. Here we have 12,500, which gives us a gain before relief. Gain before relief of 62,500. Right, now the question is, what is the gift relief? Technically, if this business had just business assets, all of this we could gift relief, if you like, but it doesn't. It says here that in October 2018, at the time he does this, the market value of the assets, the total assets, were 800,000. Okay, thank you very much. So we have 800,000, of which 150 represented net current assets of inventory, receivables, and cash. So these are all exempt in terms of chargeable, because we don't have capital gains on inventory and receivables and cash. So that's totally gone. So again, it's just out of experience, you start getting used to what we consider to be chargeable assets. We can't sell inventory and receivables and things like that as part of chargeable gains, no. Land and buildings, 550,000, and 100,000 for investment property. So here are our chargeable assets. These ones are chargeable business assets. These ones are just chargeable assets. They are all chargeable to capital gains, but this is the actual business assets. So the argument, the straightforward argument really is that what percentage of this gain can we actually use for gift aid? and that would be the 550,000 divided by the 650,000, which is the sum of all the assets, times the 62,500, right? Which pops out at, if you like, 52,885. So we now have a allowable gift relief that we can use of 52,885, and therefore the difference, which is, if you like, 9,615, is realizable and chargeable straight away, because that has nothing to do with business. So you can see the angle here is always trying to isolate the charge that has to do with business and separate out the one that doesn't. And yeah, so that's kind of how that works. And so there we are. So there you have that. The cost currently of this is 75,000. So you can gift relief 52,885, which brings the base cost, of course, 75,000 minus 52,855 to 22,115, and that's how we manage this. Cool, great stuff. That brings us to the end of this. So again, you can see towards the end of the chapter, this is slightly tedious. It's something we have to go over and over again and make sure we're comfortable. But I think once we work through a few questions, which is what we'll be doing over the next couple of weeks, we'll be in a much safer and happier place. Cool, great stuff. See you in chapter 22.